Welcome back to Money Pop. Today we are unpacking a striking outlook on silver, the stock market, and the bond system, drawn from the work of analyst Michael Oliver. His view challenges the mainstream narrative, and if his momentum readings are correct, the next several months could reshape how investors think about monetary metals. Let's start with silver. Oliver believes silver could climb to somewhere between $300 and $500 an ounce, possibly as soon as this summer. That is a bold call, but he supports it from multiple angles. Price-based arguments, monetary evaluation arguments, and historical comparisons to how other markets have behaved under similar technical setups all point the same direction. Now, when he talks about momentum, he is not referring to the standard indicators you see for free on a quote screen like RSI or MACD. Those tools tend to capture short to intermediate term movement. Oliver looks at the structural action of momentum. When you plot price, you see one structure, but when you plot momentum, you often see a subtly different structure underneath. And historically, when major trend changes occur, whether at tops or bottoms, momentum tends to lead the way. It breaks out first, and then price eventually catches up and gets the message. Look back at silver's path over the last few years. There was the surge in 2020 that lifted silver up toward $30. Even that move did not reach the top of the multi-decade range, which was 50. Then silver went sideways from late 2024 into early 2025, hovering around $35. In June of 2025, it came back up toward 35 again, and Oliver's work flagged that as the breakout. Silver was going to blow through the range highs, and other technical events confirmed that long-term silver was repricing itself into a new reality. He still believes that new reality range sits between $300 and $500. The only sticking point right now is the violent sideways action of the past 3 months from February through early May. Yes, there was what he calls a phantom high near $120, but silver was only up there for a matter of hours or a few days. It never truly lived at that level. It was a gaseous price, and it collapsed in a single day on January 31st. That collapse was followed by a lower low into February 3rd in both silver and gold. In silver's case, the low came in around $66. From that point, silver entered a violent up and down range. Then in late March, headline traders piled in around the Iran conflict story. Fears of global depression and rising oil prices. There was a sharp sell-off. Oliver's team had actually warned in a report ahead of the March 23rd sell-off that silver and gold would slide down and take out the February low. Every chart watcher could see that $66 was the key level. If that broke, the bearish crowd would say it was all over. On March 23rd, silver dropped to about $61. If you study that day closely, it is remarkable. Silver spiked below the February low, almost certainly running the stops. Gold did something similar. Silver spent about 2 hours below the February low and then ripped $10 higher, right back out of the hole. Today, silver is trading roughly $20 higher than that March 23rd low. The recovery since late March has been measured carefully. If you only glance at the price chart, you might say it is just another rally inside the range. But shorter term and intermediate momentum readings disagree. Momentum says silver has climbed out of the hole and is on its way back up. Oliver argues that the March spike low was the trap. It fooled people. Now silver is headed up to challenge the highs. He says price will become more obvious in the next week or two, once the chart clears the clump of ink. You do not have to see silver back above 120, but once it pushes into the mid-90s, many traders will realize the correction is over and the uptrend is resuming. Momentum says this is likely, and he does not believe silver will go sideways for another 3 months or collapse to $50, despite what many commentators suggest. There is another important point. Back in November, silver broke out relative to gold. When you plot the silver to gold spread over a 10-year window, silver had been capped at a very low level versus gold for years. In November, it broke through, and the sharp pullback in price since then has not dented that relative performance shift. The spread still tells us silver is the upside leader. Gold is the mama market and remains important, but silver, and likely silver miners, will lead the way higher. What Oliver is really saying is that silver may have already finished its shakeout phase, even though most people still think the market looks weak. After the violent collapse earlier this year, silver briefly broke below key support, flushed out traders, triggered panic selling, and then reversed almost immediately. That was not a breakdown. It was a trap. The bigger signal is coming from momentum, not price. And silver's relative strength versus gold has already broken out after being suppressed for years. Now let's shift to the stock market. Oliver does not see a crash coming soon. He argues that the market is in a topping process. Historically, stock market tops take more than a year to fully form on the price charts. Look back at the dot-com high in 2000. It took until early 2001 before price really began to break down, even though momentum metrics had warned investors as early as 2000 that the top was in. The same thing happened in 2007. The actual crash did not arrive until October of 2008, a full year after the market had peaked. He sees sharp parallels between today and 2007. His team had called for new highs in the S&P. If you look back at the chart from early to middle of last year, the market was in a sideways range just below 7,000. The Iran-related sell-off in March pushed price down briefly, but his work said do not trust the downside. The technicals argued the index needed to go up and make a new high, and it did. What he is watching now is the behavior of the next few months. Last month was strong. This month has shown follow-through, but if you start to see a quiet, laborious rollover, nothing sharp, no headlines, no panic, just a slip back down into the upper 6,000s on the S&P by the end of the quarter, that is the signal. When the next quarter opens, if his momentum numbers are violated and price falls back into that prior range, especially the upper 6,000s, that confirms the top is in and the market is headed lower. Does it have to crash? No. A crash means 30 to 35% in a couple of weeks, and he does not expect that. He thinks the topping action will roll over quietly for several months. Later in the summer, you could see sharper downside. For gold bugs and silver miner owners who panic at every stock market sell-off, he says you do not need to fear a crash event. What you should expect is a major top forming in the US stock market. That matters for gold and silver because money flows. If investors begin to perceive that stocks are not a good risk reward, money will move elsewhere. Treasury bonds are not working as the alternative, so the only asset class working quarter after quarter is monetary metals. Yes, gold and silver pulled back sharply since late January, but the long-term trend remains upward when you look at it every couple of months. The other area to watch is Treasury bonds. Oliver argues we do not have a mortgage crisis on our hands. We have a government bond debt crisis. The T-bond market is on the edge of a potential panic situation, and the panic will be felt most by the Federal Reserve. The Fed cannot change the budget, but it can print to defend the bond market. That is the playbook. Very few people are focused on the credit conditions building right now, especially in corporate debt and commercial real estate. The financial sector is behaving badly compared to the broader stock market, in a way that echoes the warnings of 2007 before that major top was confirmed. Oliver believes we are at that point now. The catalyst that will drive monetary metals off the page is printing by central banks. The Bank of Japan has already been doing it. The Prime Minister over there said months ago that they would print to save their bond market. The United States is heading into the same situation. Even Jamie Dimon, head of JP Morgan, said recently that we are headed for a bond crisis and we will have to deal with it. He called it a government debt crisis, and he framed it as happening now, not years from now. Oliver's technicals argue Dimon is dead right. If you have followed this far, you probably see the situation a little differently than most investors do. The real story may not be whether stocks go up or down next quarter. It is whether the underlying structure holding together equities, bonds, and currencies is weakening at the same time. Silver, gold bond yields, and central bank policy are no longer separate stories. They are becoming the same story, and if the bond market really is approaching the kind of pressure Oliver describes, then the next question becomes what happens to the financial system when confidence itself begins to need liquidity support.